So, Jesse, diving right into it, why is democratizing access to private markets important for the economy and for everyday individuals?
Yeah, we are diving right into it. Well, I think that, as you examine the broader economic landscape and the potential to gain outsized returns, it's pretty clear that most of the consistent outsized returns come from private markets. And the biggest barrier inside private markets is your wealth status. And so, if you, I like to use this example. If you held everything else in the economy as exactly the same and equal for everyone, but you just left accreditation in place and allowed unaccredited folks to have access to public markets and the accredited folks to have access to both public markets and private markets, the wealthier are going to continue to outpace everyone else and become wealthy and wealthier by comparison if everything else was the same. And I think that's very telling, right? So why are the rest of us locked out of the most lucrative asset classes? And I've come to question that. And there's a lot of good reasons why there should be precautions around it. And I don't want to throw caution to the wind because there does need to be good education and good intermediaries involved to help folks that are not as familiar with these markets to make good investment decisions. But at the end of the day, those things can be taken care of. And if we do allow that at scale, it will make a massive impact across both the public industry, the public markets industry, and the private industry.
All right, so what you're doing with Sweater, I think, is so valuable and important right now, and you're only able to do it because of recent changes in the legal structure in the US. So let's take a step back and talk about what the accredited investor status means and why it's existed to begin with before we get into how you're disrupting that.
Well, let's see how far down the rabbit hole you want to go. But I mean, if we should start with accreditation, I think it's important to understand where it came from. And this was the beginning of my journey. So accreditation laws really stem from post-Great Depression America. I mean, everything that happened with the stock market in the late 1920s and early 1930s was a total disaster. And there were charlatans running the streets. I mean, like it was truly as unregulated as you could get. And there were bad actors. There's always going to be bad actors. And so the conversation in the 1930s in Congress was, how do you protect widows and orphans was the common thing they threw around. How do you protect widows and orphans from being taken advantage of? And so with some of these more sophisticated financial products, they decided that there needed to be some level of measurement to determine whether or not someone could be there and not just invest in it, but also on the flip side of that, what makes for a sophisticated investment and how you qualify to be able to offer that to the public. It was a two-way street. And ultimately for accreditation, they decided as they were examining all the different ways they could measure sophistication, they decided to use wealth as the tool. And, you think about it and it's like, on one hand, it's very unfair, right? I think we all know plenty of smart, unaccredited people, and we probably know some accredited folks who aren't that smart, right? It goes both ways. And not to be disparaging to anybody, but you run the gamut on both sides of the spectrum. And so when you examine that, it's like, okay, well, maybe there's some fairness, and maybe appropriateness in the middle of that. But at the same time, when you pull back the curtain, it's like, why did they use that? Why couldn't we, like there's conversations now about taking a test or actually being able to determine you as an individual whether or not you're sophisticated, which makes a lot of sense, but it's still not in place. And so, I think that there could have been better ways that they did it, but it was also the 1930s, 1940s, and there weren't as many systems in place. Today we have access to information at our fingertips to the extent that we want to go and find it. I mean, it's just a different world today, which is also part of the reason that it should change today.
So you're touching on what I think a lot of people think a lot about when it comes to investing, that it's a risky thing to do, whether you're in the private or the public market. And so people like to think there should be some protections in there. And the accreditation status is a way of that the government created to try to provide those protections that really closed off big opportunities for a lot of private individuals, though, who just weren't as wealthy as those accredited investors. So why is it opening up now? And and how has it been opening up the last few years?
Well, I think there's been a number of conversations happening to recognize this. It really started about 15 years ago with the Jobs Act. the whole conversation that led to the Jobs Act. So the Jobs Act was passed in 2012, but it was an open conversation from about the time President Obama was put into place as president. And the conversation was legitimate and I think fair overall. The and the idea of what came out of it was regulation crowdfunding. That was the first real step in the last couple of decades, really the last 50 years, that took any step whatsoever to try to provide some access to private markets for the everyday individual. And
I'll jump in
regulation
there actually.
crowdfunding,
I was
yeah.
talking with Paul Allen just a couple of days ago about this, and right now, private companies are able to raise up to $5 million a year through crowdfunding. I think there's talk about that being increased, but that really has started to open
Mhm.
up and given access to private markets to a lot of individuals that wasn't available before, right?
Yeah, that's right. And so the Reg CF, and this is where, all good intentions, it was not rolled out very well. The law was passed in 2012. It didn't actually come online. It took 4 years to go through the rulemaking process to actually launch the law. And so it came live in 2016, but it had all kinds of flaws associated with it, which created a rift between the crowdfunding world and the venture capital and venture backed world, which took several years for it to play out. And they made some corrections, including increasing the limit from being able to raise 1 million on Reg CF to being able to raise 5 million today. That passed about 2 years ago, maybe 3 years ago now. You could also create and lump everybody into an SPV now, where when it first launched, every investor that came into the company had to be on the cap table. So if you had 500 people that joined your Reg CF, you had 500 people on the cap table, and VCs hated that. Sophisticated investors hated it. And so they've made some improvements and it's gotten better. And Reg CF is kind of like level one. Level two is called Reg A. You can actually raise up to 75 million a year. And that's almost like a little mini IPO. It's very highly regulated. And there's a bunch of constraints around that too. And what those two things do is that they allow you as an individual to examine a singular company. And they have all these disclosure requirements and everything. You can look at all the information, decide if you want to invest your money directly into that company. And it's great. But the implementation was flawed. And I think that the Reg CF and Reg A world is still reeling a little bit from that, trying to get a foothold with getting access to the highest quality companies that are out there. Those are still very exclusively backed by venture capital funds. And one thing that I'll point out, and then we can go on to other questions, is that Reg CF and Reg A plus, while they're fantastic moves in the right direction, they disallow the pooling of capital for investment purposes. In other words, you can't create a fund using those regulations. So you ultimately, as the individual, you have to find your own deals. You have to conduct all of your own diligence. If you want to offset your risk, you need to make all of your own investments, which means you really should make 30 investments or more. So you have this portfolio risk that has reduced your risk. And most people aren't going to do those things. Most people don't have good deal flow. They don't know how to conduct good diligence, and they're not going to make 30 investments, which is why we believe what we're doing with a fund approach is a level above, from an experience and a fit for the unaccredited investor, a better fit than the Reg CF and Reg A plus world. But there's room for both.
So let's dive into that. So up until just a little over a decade ago, if you're an unaccredited investor, you couldn't access the private markets. Then you had crowdfunding opportunities available for startups. But that, like you said, that required every unaccredited investor to find their own deals, do their own diligence, build out their own portfolio. And what you're doing now is allowing unaccredited investors to be able to invest in funds that are able to build out those portfolios, do that diligence, and give them even more exposure to hopefully minimize risk, but also participate in other opportunities. How did that come about, and how did you jump into that in particular?
Yeah. I mean, this is the place where, there has been some regulatory movement on the Reg CF and Reg A plus world. But in the world that I operate in, there hasn't been any regulatory changes. We actually leverage a fund structure that was put in place back in the early 90s. But it didn't really take off at the time because mutual funds and ETFs really exploded during the 90s and the 2000s and took all the attention. And so they were kind of the lost wandering stepchild out in the financial ecosystem until about 10 years ago when they started, fund managers started realizing the benefits of how these fund structures work. So the technical name is they are an unlisted closed-end interval fund, which is just a fancy way of saying that it's like a cousin to a mutual fund. So it's different from a traditional VC fund. for a lot of different reasons. Traditional VC funds, they have a lot of benefits for the investors, but there's a ton of constraints, many of which prevent the everyday investor from being able to invest. One of them is that you do have to be accredited. So automatically, 95% of the population is out because they don't meet the accreditation standard. Secondarily, they can only have 99 investors. And under certain circumstances, very small funds can have up to 250. But for the most part, it's 99 investors. And that drives the economics of the fund. If you want to raise a $100 million fund, the average check has to be $1 million. And so, most people, even most accredited investors, can't put money into a VC fund because of the way that these economics work. And then there's one other big constraint for the fund manager, which is they can't publicly solicit. They can't advertise the fund, which means that they have to go, you have to know a guy, right? You know the person who knows the person who's raising the fund, and you kind of weasel your way in, but it's very difficult. There's no marketplace, true marketplace for funds. And so those are like the constraints. So these unlisted closed-end interval funds, let's just call them interval funds. Interval funds are of great interest because they remove a lot of those barriers. You don't have to be an accredited investor to participate. You can just be a regular person. You could be a plumber, like a lot of my friends that I grew up with. You could be a teacher. You could be a firefighter. You could be an analyst at some other fund, right? Like you could be anything you want, and you can participate. There's no limit on the number of investors that can be involved. So you could have 500, 5,000, 500,000 people involved in a fund, much like a mutual fund. And then because of that, it brings the economic requirements down. So you could have a minimum investment. The fund managers can provide a minimum investment that's more like $500 or $2,500 instead of $250,000 or $1 million like traditional funds. But then they can go and they can invest in all the same deals that a traditional VC fund can invest in. And so we were the first ones to take a venture capital fund and actually take it direct to consumer. So we built a modern investment technology experience, wrapped it around this interval fund, and we were able to market it through Instagram and Facebook and YouTube and everywhere else to be able to provide this opportunity directly to people without any other intermediaries. And so that's where we really broke the ice. And as one this like last step in our evolution is that while we started that first fund, that pilot fund, we know that if we want to change the industry, we needed to enable other fund managers to be able to do the same thing that we did. And so we've opened up our technology and our compliance expertise as a platform for outside partners to launch their own funds. And by doing this, we believe that we can help launch hundreds of funds out into the world, support them in the very specific needs that they have, so that the general public can have a very wide selection of being able to invest in venture capital, private equity, commercial real estate, or private credit. All of these, broad, private market industries that are locked out or that lock out the public today.
So I think this is a really exciting space, but I have to ask, how much demand do you think is actually out there for unaccredited individuals to access the private markets?
Well, this has been an actual movement that started a couple of years ago when inflation started going up. So when we had zero to low interest rates, at least at the Fed level, the bar for having outsized returns was lower, just generally lower, right? So when you look at like a wealth advisor or even like a day trader that's managing their own portfolio, you could get really great returns because the cost of capital was very low. And so you could get a 10, 12, 15% return profile if you did a good job just by being in public equities. But as interest rates went up, all of a sudden that bar for outsized returns went up too. And so now it's harder to find outsized returns. And so wealth managers specifically are looking towards the more sophisticated and exclusive end of the spectrum when you're looking at family offices and wealthy individuals and big fund managers and saying, well, how are they getting outsized returns? And the dirty secret that's out in the open is that it's in private markets. That's how you do this. And so now there's becoming an increasingly strong conversation happening with the wealth manager level that manages most of the wealth that's out in the public markets, saying if we want to provide outsized returns to our clients, we have to get exposure to alternative investments and to private markets. If we don't do that, we are going to fall behind. And that's becoming more and more common. And so this fund structure in particular really caters to that world because it uses the same kind of, functional logic and the same infrastructure as mutual funds and ETFs, which is where wealth managers tend to move most of their capital to anyways that they're managing. And so this conversation has picked up, and there are literally trillions of dollars under management in the public markets that are managed by traditional money managers, or RIAs or wealth managers, whatever you want to call them, that has the ability to bridge over and move a lot of that capital. There's about $35 trillion sitting in capital in public markets, and move it over into the world of private markets, which is sitting at about 15 trillion in assets right now. And so we believe that we see this movement happening, where a lot of the money that's been locked up in public markets is going to start bridging its way over. And over the next 10 years, it's our belief that the everyday person, and definitely the everyday wealth manager, is going to talk about interval funds in the same way, in the same notoriety and familiarity as they do mutual funds and ETFs today.
So, how do you go about actually getting to that stage? What are you doing right now to educate wealth managers, to educate the unaccredited investors, or what do you have planned coming up to make that happen?
Yeah, well, I mean, the good news is that it's happening with or without me, and with or without Sweater. I mean, this is already something that's got its own legs and it's already moving. Just as an example, 10 years ago, there were less than a dozen interval funds in the market, and they represented about $8 billion worth of assets. 2 years ago, there were about 150, and they represented somewhere around 100 billion in assets. Today, there are over 250 interval funds and tender offer funds, which is a very close sibling, and they represent over 250 billion in assets. Last year alone, there were 50 new registrations that increased the number of available funds by almost 30% in 1 year. So that's already happening. And the reason that that's happening is because there's A, wealth managers and fund managers have figured that out, but B, it's because there's demand for it and money is moving into these vehicles. So, like we're sort of riding a wave that's at the front end of the growth cycle. So that's already happening. But then on top of that, I mean, for us, we're trying to get ourselves out there and make friends with both fund managers and wealth managers so that they understand how these worlds work, and trying to find partners that can build on our technology platform to be able to provide these directly to the public. And so, that goes through a lot of networking and meeting with smart people and word of mouth. But in the coming year and a half, we're going to be spending a lot more time at RIA conferences and wealth management conferences to be able to get the word out. Additionally, that this type of approach is that like, I guess the direct to consumer approach is also very achievable and sitting right in front of us.
So, imagine yourself in the shoes of a venture capitalist, private equity firm who may want to bring more investors on, unaccredited investors. It does seem like it's still a lot more work for them to do this in order to find those individuals and onboard them to this. What's the process like for one of your partners that decides to work with you in setting one of these funds up?
Yeah. So in the early days, I think the way that we see it over the next couple of years is our best match to work with us and truly go direct to consumer are working with fund managers that have some kind of a market presence or some kind of an audience that they already have credibility with. So it's very different working with a group that doesn't have any access to influence or reach from a traditional measure, than it is to work with someone that does have some kind of an audience or a reputation that they can automatically launch a fund to. So we're talking to fintech and like wealth influencers that are hot on social media. Another group that's outside of us that we're friends with is someone like Kathy Wood. Kathy Wood has an interval fund called ARC Ventures. And she can go, she has a massive audience and a big voice that she can take this stuff to. We're working with professional athletes and others that can also represent these types of funds. And so there's a lot of different angles that you can take as a wealth manager that we would work with, as a fund manager that we would work with to help them set the foundation to get to where they need to be. But that's one angle. I mean, we pioneered going direct to consumer and being able to provide a direct investment portal that's connected to their website. They can send their audience there and whoever else they want to advertise to. And when someone clicks that invest button, it goes into our workflows that's white labeled for this partner. And we take care of all the KYC and AML and connecting to your bank and conducting redemptions and reporting on your investment. And we take care of all that stuff on the back end. But that's just one channel. There's also other channels. You start looking at consumer brokerages like SoFi. And SoFi has opened up an alts investment portal where they're only offering up interval funds. And they started about a year ago with a pilot group of 5 funds, and it went so well that they're going to be expanding it dramatically. And so our pilot fund called Cashmere is set to be listed there within the next 60 to 90 days. And all the funds that we support, we expect to be there. And of course, SoFi is not going to be the only consumer brokerage that does that. We fully expect that Webull and Robinhood and Public.com, all these different groups are going to need to have this access for their customer base to alts, or else they're going to lose customers because those customers are going to go places that do offer alts. And so we expect that to continue to grow and blossom. And then there's the what we lovingly call the legacy infrastructure that exists out there, which is where most of the wealth managers live. And they go to the Charles Schwabs and the Fidelities of the world to access these types of funds. And there's a bunch of strategic reasons why they want to do it that way. And so we help accommodate that. And as a partner launching one of these funds with a group, we actually will, we're the enablement layer. We take care of all the compliance stuff. And we also do all the technical requirements of getting this fund served up in any channel where they may be able to find potential investors for their fund.
All right. So you mentioned Cashmere Ventures. Tell us a little bit about what's unique about that and what it's going to look like.
Yeah, so Cashmere was ultimately, so back up a little bit. So our company's name is Sweater. And Sweater, when we first figured this stuff out, we knew that we needed to do more of a platform approach and enable outside fund managers if we really wanted to impact the industry. But we also knew that nobody would do it until someone else did it first. It was very classic chicken and egg. And so we decided that we needed to launch the first fund to prove that it was possible and reduce the risk for everybody else. And so we launched the Cashmere Fund as our first foray into the market. And we decided to launch into the most difficult fund for a lot of compliance and technical reasons, which is an early stage venture capital fund. And we put that out in the market in early 2022. It's been out there for 3 years now. It's got over 5,000 investors in it. It's made 35 investments into early stage technology and consumer companies. And it's doing great. We just brought in a new partner on it to really take over the promotion of the fund and the capital deployment sides of the fund. So we can really focus on the rest. Effectively, we sort of converted it to being like a client or a partner on our platform. And so it's doing great. And it's, I guess its thesis is to invest in early and mid-stage companies that focus on a consumer element at the core of it. So both technology as well as physical products that everyday people can relate to and can even go in and purchase the product or interact with it, or they may engage with it in their workspaces. It's something that's very broadly available. So like, as an example, one of the companies that's blowing up right now is a direct-to-consumer olive oil company called Graza. And Graza is blowing up. They're easily going to be doing 9 figures this year in revenue. When you watch cooking shows on, or reels on TikTok or wherever else, you'll often see them using Graza olive oil just in the day-to-day. And they've really done a good job of getting it picked up. And they're doing great. I mean, my expectation, they'll probably get acquired sometime in the next 2 or 3 years. But we got lots of technology companies and stuff inside that fund. And the new partners that came in, their goal is to get it to 250 million under management in the next few years. And they definitely have the social connectivity to make that happen. And they have a couple of big announcements coming up that I can't talk about quite yet, but there's some big names that are going to be involved with helping to promote the fund. And that's very much part of its thesis, is leveraging influence and the consumer angle to be able to take companies and accelerate their growth.
Well, Jesse, this is all incredibly exciting. I really appreciate what you're doing to give access to the private markets to people who may not be as wealthy as others and so are unaccredited, and what you're building up with Sweater, with Cashmere, and everything else. Really, thank you for doing this.
Yeah, well, it's my pleasure, right? Someone's got to do the dirty work, and I might as well crack my skull against the brick wall. I've been doing it for 7 years. I can keep going.
Here, here. Keep it up. And thanks so much for joining the
All right.
podcast.
Hey, thanks for having me on, Alexander. I appreciate it.